Welcome to Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Gary Booysen from Ransus. Be sure to send your questions through via email at stockwatch@bdtv.co.za or via X using the hashtag Stockwatch or via SMS to 41392. Thank you so much for your time, gents. It is the first day of first trading session of Trump 2.0. A lot has been said, a lot has been happening, a lot has been signed. Gary, just starting off with you. Anything that you as an investor, you were looking out for that stood out for you that could affect any kind of sentiment towards the market at this stage?
I think we expect a lot of change. And when you have these kind of sweeping executive orders, which can still be blocked by the courts, can still be blocked by Congress as well. So I think the market is taking it in its stride. But when you do have these big and dramatic changes to a very complex system, the ramifications are often very uncertain. So I think my approach has been really to look at the market as it opened today. Obviously, it was closed for the Martin Luther King public holiday yesterday, and just see how the market is absorbing this. And so far, so good. The S&P 500's up around 0.5%. The dollar index is slipping back a little bit, so we're seeing a little bit of weakness in dollars. And I think what we were relieved to see is that, yes, there's going to be tariffs coming in, but it seems that the Trump administration has taken a little bit of a softer stance than could have been taken. And the focus is going to be very much on immigration through Mexico. And, changing the Gulf of Mexico to the Gulf of America, for example. So I think so far, so good. But obviously, I think it's going to be a wild ride for the next 6 months or so.
Well, talking about a ride, oil is going through quite a ride right now. And I see as a result of that, Sasol, of course, we saw softening in the oil price after Donald Trump declared a national energy emergency. And actually what's interesting with Sasol, because there had been this optimism, I think, what was it, last week, Friday, the share price was at 103, 105. It is back to 95 Rand today. And JP, because I was wondering, of course, now there was news of that they want to list the chemicals business. And a lot of people thought that would be what Sasol would be trading on right now. But it seems that we're now back to the fundamentals where, for example, oil has gone down. And so Sasol is following. Just what do you make of that story?
Yes, and I agree with your assessment. I would add to it that maybe people got a little bit ahead of themselves when the CEO just made some off-the-cuff comments that they will probably one day list the chemicals business separately. One day can be a lot of days into the future. And a lot needs to fall in place before they can do that. I wouldn't be surprised if it's actually an old plan that Christina Ramon, who was CFO at the time, when that's when they thought about this thing, when they built Lake Charles, ultimately to split the business. If you look at the sunset that the South African operations are inching towards, and that plan was there was a spoke in the wheel of that plan in the form of COVID. And because of that, they needed to sell half of the Lake Charles operations. So it's not so easy to continue along that path. And that's why I do think it might be a while. And I think people are realizing it might be a while. And the longer it takes, the more it means that the degradation of value of the South African business, especially with lower oil prices, as you mentioned, is going to be hurting shareholders at the moment. So yes, Sasol got to very, very cheap levels when it got into the 80s. Bounced above 100 even. But I think over the next while, we'll probably get a few of these stories.
Yeah.
There'll be this glimmer of hope. Sasol will show some life. But as you say, then the fundamentals will reassert themselves. And ultimately, I don't think they have a solution for the fact that the South African business is inching closer towards its own sunset.
I do feel sorry for a lot of our Stockwatch viewers because I know a lot of them hold Sasol, and I'm sure a lot of them were hoping that there would be more upside to this. Talking about upside, let's go into MTN. Gary, MTN, is it a hold or a sell? Well, a lot of people have been buying because today it surged, 6% after the gain that we saw last week as well on the news of the tariff adjustment in Nigeria. would you be selling at this point when it comes to MTN, Gary?
No, I don't think. Well, I'm a long-term holder of MTN as well, and it's been a rocky ride, and sometimes it has a little bit to do with the oil price, thanks to Nigeria's economy as well. But yeah, looking at it, I think if you were in it for the short term, I mean, if you were buying in the 80s, and it's been kind of fluctuating between kind of 85 and 90 for a long time, so I think a lot of shares might have changed hands there. Yeah, sure. If it's a short-term position, you can look at exiting. As you said, like the excitement around the company at the moment, coming from obviously the NCC allowing that 50% tariff hike. They were lobbying for 100%. This is the first one I think in 11 years, so more than a decade since they were allowed to increase prices. But the risk premium that's been associated with the MTN for a long time since that NCC fine, I think should reduce. I don't think it has reduced, but I think it can reduce because you have a big Nigerian client, not just client base, but shareholder base as well, thanks to the Nigerian listings. So, it makes up around about a third of their revenue coming out of Nigeria. So the very good news that they can now get that 50% potential 50% tariff increase. That should feed into the business. It's not particularly expensive. Nice dividend yield at above 3%. I've always preferred it to Vodacom, which is technically the safer option of the two. Obviously, MTN operating very much in frontier markets. But if that's what you're looking for, if you're looking for exposure to Africa and exposure to frontier markets, I still think it's something. So I'm holding it at the moment. I'm not selling it. I'm probably not buying it today because we have been buying kind of in the 80s. But yeah, it's still a happy holder.
Yeah, I feel like at this point, nobody's really trying to sell. But of course, we're trading on the news of this tariff adjustment, JP. But I mean, there have been deeper issues in Nigeria, particularly with the currency devaluations and, challenges in terms of repatriating those profits. Does this now override the challenges that have been going on, or would you still be looking at those and still seeing those as still a dark spot in Nigeria for MTN?
You're reading my mind, Zanati. So yes, I agree with you. I think this positive news is obviously good for the MTN share price in the short term, and it does help them to increase their profitability in Naira terms. But the longer term issues has more to do with the weakening of the Naira and the issues they had to repatriate money, not just from Nigeria, but a few of the jurisdictions that they operate in. A higher oil price in general and a more stable Nigerian economy should assist that maybe they can more easily extract the profits out of these types of jurisdictions, but it's still an issue. And, sometimes what's quite useful when you have a complicated situation is what they call to step back and look at the outside view. So in investment markets, you have the inside view and the outside view. And the inside view is you look at all the details and what's happening here. The outside view is you step back and you say, have there been similar situations and what in general happens to, in this case, telecommunication companies that operate in frontier or emerging markets? And in general, at some point, once the super growth slows down, when most people have got their cell phones in their hands, it becomes utility and it goes sideways. And yes, it's a decent dividend yield, but the dividend yield struggles to grow. We've seen that story play out with Vodacom. Share price just continues to drop down as the growth disappears and people just own it for the yield. And I wouldn't be surprised if MTN goes the same way in the next few years. So I think if you want a yield return, you can look at MTN, but I think the days of a strong capital return are behind MTN. And over the long term, I think these other forces will reassert themselves.
All right. Well, gents, let's go into Super Group. Is this a hold or a sell? I do remember there was quite some selling towards the end of last year with the sale of that Australian business. What do you make of Super Group, Gary?
Obviously, you got a nice share price bump off the SG Fleet deal, which, at the moment we don't hold Super Group. I'd probably be selling Super Group at this stage. We've got obviously a high interest rate environment. It's going to make it difficult. It is fairly diversified. Only about 44% of its revenue comes from South Africa, but there are real logistical challenges in South Africa. If you look at coal export volumes, delays at the ports, that kind of thing. Yes, there's a little bit of optimism around the GNU, but I think a very, very tough operating environment for the business. So I think I'm avoiding it for now. Not that I think it's a bad company. I think it's just a very difficult macroeconomic headwinds.
Yeah, and there was also a question of, I guess, maybe investors not knowing how to really value the assets that are left in the business after the sale of that business that was basically seen as the crown jewel or one of the crown jewels. What's your take on Super Group, JP?
Yes, no, again, I agree with your assessment. I think if you look at the implied valuation of what's left after FG Fleet, mostly a South African business, a little bit of European exposure, some UK motor vehicle dealerships, um, but much more SA exposure. And that's the macro headwinds that
Yeah.
Gary has referred to, which I think people are concerned about. But at an implied PE of something like 4 times at this share price, that's very cheap. So I wouldn't be surprised if you go back, say, a year to Life Healthcare before they paid that very big dividend when they sold AMG, or some other companies that sell the operations and distribute a big dividend. Zeda is another one that comes to mind.
Yeah.
People usually don't give the full value to what is left after the distribution. And then you get a nice bump afterwards when people realize, oh, wow, this is quite a cheap valuation now that the cash is being distributed to shareholders.
Yeah.
So I wouldn't mind having quite a nice exposure to Supergroup at this price. You wait a couple of months, you get your cash back for SG Fleet. If you do it in a collective investment scheme, that's quite tax efficient. You don't pay dividend withholding tax like you would do if you were an individual holding the Supergroup shares. And then what's left, I think, yes, headwinds, but very cheap at the moment. So you could see a little bit of a bump after the distribution happens.
JP, let's come to you just talking about companies that, have this cash and then they pay out these dividends and then investors have a problem valuing what they have left. RMB Holdings.
Yes, it's another one of those. So what you have at the moment is effectively Atterbury Property Group, the Atterbury Holdings business. We have a minority stake through RMH, and that's a very dynamic property developer. Very good track record of creating value through property developments. They built the Mall of Africa, for instance, in Midrand, in Waterfall. And if you look at the net asset value of RMH, it is trading at a significant discount. And after they paid out that cash, you can more easily value that because what is left is now not just anymore a portfolio of different businesses.
Okay.
It's the Atterbury business. A few hedge funds have taken note and they bought significant stakes. So you could see some activism, you could see a value unlock. And I would expect in the next 5 years that maybe RMH Holdings will not exist anymore.
Yeah.
Because it doesn't make sense that a listed company is effectively only a conduit to a minority interest in a private property developer. So yes, maybe one to keep in your bottom drawer and keep an eye on.
Gary, is this one that you look at all?
No, not really, but maybe I'll just talk about property more generally.
Okay.
I mean, the share price has actually done fairly well in RMH, and as Jean Pierre was saying, it's got Atterbury helped develop Mall of Africa. I think it still maintains a 20% stake in that. You've got the Newtown precinct that owns 100% of, but again, it's an interesting way to get into property. And then at the same time, I think the whole of last year I was very constructive on South African property, international property, just with the view that interest rates were going to come down aggressively. And looking at the expectations going out over the next year, we're talking about maybe one, maybe two interest rate cuts from the Fed. I mean, we've obviously got the Reserve Bank meeting on the 30th as well, and we'll probably get 25 basis points there. But you get a sense that the cycle is going to be a lot shallower. And I think if you look at the individual asset classes, I mean, South African property was one of the best performing asset classes of last year. So to go piling into property, even maybe not through this vehicle, but through a different vehicle at this stage, I think. Yeah, I mean, maybe this is the vehicle to do it because at least there's that discount to NAV, but kind of going into kind of like let's say the property trackers at this stage, I think you might struggle given the performance of property over the last 12 months.
All right. Well, gents, let's go into hospitality. There's a question on Sun International and one on City Lodge. If I remember correctly, JP, you are more constructive on Sun International. Am I right?
I like them both.
Okay.
City Lodge has disappointed me. So if you take back a year, I thought City Lodge would do better than Sun International. It didn't. That notwithstanding the fact that if you look at the latest casino stats, casinos are struggling because online gambling is just taking market share.
Yeah.
But what Sun International has done really well is through SunBets, they've really gotten into the online gambling business to offset the pressure they might have been feeling on the casino side. And City Lodge obviously has got no gambling. It's only the hotels and it's all about occupancies. And they came out late last year saying that occupancies, the latest numbers are a bit disappointing. So I think I'm not the only one who's been disappointed in City Lodge, but it is trading at cheap levels now. So maybe in the coming year, even though Sun International did better than City Lodge, who knows? The tables might be turned for the coming 12 months.
Yeah, actually, I feel like half of the people that I've spoken to are for Sun International, are for City Lodge. So at this point, I don't know if we should compare them. Gary, what's your take on those two?
No, I'd probably lean towards Sun International. The gaming business, I think, is a little bit more exciting. And City Lodge, I mean, even from a technical point of view, the share price has traded sideways for forever. Jean Pierre was saying from late last year we had kind of an operation. It was a voluntary operational update saying that occupancies are sitting at around 58%. But again, we're in an environment where I think things might be a little bit more constrained, specifically in emerging markets. City Lodge is 95% a South African business. There's very little diversification. I think about half the business is focused on the City Lodge brand, and then it kind of goes down the rankings into the town lodges and the road lodges, etc. And it's without significant GDP growth coming through in South Africa, I think the business will keep on struggling. I mean, you can always make a valuation argument around it. But for my money, if I had to choose between the two, I'd probably take Sun International based on their movement into the online gaming side of it and just a little bit of a diversification in revenue stream as well.
All right, gents, let's go into Karooooo. The viewer has 5 O's here, 3 O's, but it's actually 5. So there's a stock that I have my eyes on. I've had my eyes on for a long time, but gee whiz, it just doesn't reach any buying levels. Hasn't reached any buying levels for a long time now. What's your view? I think it was actually when they released their quarterly results. It did take a little bit of a dip. JP, what do you think of Karooooo?
Yeah, the problem you have, and the interesting thing is it's not really a problem, is that the controlling shareholder, Mr. Zach Callisto, is holding on to his shares. He's not selling any shares, so the liquidity is quite low. But I mean, you can't blame him because the company is delivering, showing strong revenue growth, good profit growth. So there's no reason for the founder to sell. And I like it when a founder's got a significant stake. It means that he's eating, breathing, living the business, as I'm sure Mr. Callisto is at the moment in Singapore after he moved there. Mm-hmm. And if you can get some shares, which is difficult because of this illiquidity, yes, then you can go around for the ride and benefit from his energy levels that he puts into the business.
Yeah.
So low liquidity, you might struggle to get that opportunity. But if you get anything close to an opportunity, you need to grab it because of the low liquidity.
Yeah, and actually just looking at that chart, it's been going up and up and up. And actually even just that dip that we saw last week was, it was small. Your take on Karooooo, Gary?
Yeah, it's not really one that I cover, but I'm just looking at ownership summary at the moment. So 63% of the business owned by Mr. Callisto. So yeah, absolutely, he's going to do well if the share price does well, and I suppose you can benefit from it. At the same time, when he decides he's had enough, and if he ever decides to start selling shares into the open market, he's going to move the share price a lot as well. So yeah, I think the liquidity is definitely just a concern. So not one that kind of makes it onto our radar.
All right. Well, there's an interesting one here. Pick n Pay and Afrimat both fell heavily today. I actually didn't see that. Any specific reason, JP? And actually, our market was up slightly. So what was up with Pick n Pay and Afrimat?
Sure. Okay, I'm going to put myself in the shoes of the sellers of those two shares and guess what they thought. I would say in the case of Afrimat, there is some concern regarding some exposure they have to ArcelorMittal.
Oh, yes.
I think they can manage through that, and the Lafarge business sounds like it is turning around. That other announcement to say that the CFO that previously was seconded to that business has completed the integration, so that's good news from Afrimat. But some people might be nervous regarding the ArcelorMittal news. And for Pick n Pay, remember, Clicks came out with a trading update, and maybe the top line was lower than people expected. So in general, retail got a bit of a knock in confidence. And Pick n Pay shares have done very well on the back of the Boxer shares that have done quite well, and people thinking that solves for the Pick n Pay balance sheet. I think it's going to be a few more years before the Pick n Pay balance sheet looks healthy again. So I'm also not a bull on Pick n Pay shares, and it looks like some people also turn their sentiment a bit negative towards Pick n Pay today.
Well, actually, I mean, what was up with Clicks, Gary? Because I didn't see anything wrong with those numbers that they put out today, but they got punished by the market.
Yeah, obviously not meeting expectations, but I don't know. You get the sense that maybe a lot of traders aren't paying back properly at work yet, and maybe people aren't reading the sales announcement as closely as they should. Because yeah, absolutely, comparable stores sales up 5.9% for the 20 weeks. Turnover up 8.1%. I mean, it isn't massive given kind of like the premium that Clicks trades on, but you compare Clicks to something like Discam. I mean, you get a sense that that's what you're expecting in the sector. So yeah, I don't know why everyone was so surprised, enough to mark the share down almost 4%. But I mean, the only thing I can say is that it is an expensive share. So if you're trading on kind of a last 12 months earnings and PE of 30, that's not hugely positive results. But this is something that we've come to expect from a company like Clicks. And I don't know. Maybe it's some foreign shareholders selling as well, because I mean, generally, like these kind of the defensive retailers there's a lot of foreign interest in them as well. So maybe people pulling a little bit of money out of emerging markets after the inauguration, also just putting a little bit of downward pressure. But yeah, difficult to get into the mind of the sellers today.
All right. Well, JP, earlier on you spoke about company leadership having their head in the game, and Datatec is one of those where management is also involved in that kind of ownership structure. There's a question here: does Datatec still have any legs?
Interesting question. So yes, Jens Montanana has got quite a few shares, not quite as many as Zachilista has in Karooooo, but he's got a significant shareholding that aligns the interests of him and Datatec. Look, they also made that big sell of the Westcon division and paid the big special dividend, what's it, probably now 2 or 3 years ago, and then a further deal a couple of years after that. So it's a business that was thinking, what should they strategically do going forward? And they had a review, and after a long while, some like, no, they're going to just keep on doing what they're doing with the piece of Westcon they have left and Logicalis in the IT hardware distribution and software services. So at the moment, that area is quite a hot area. It's not quite AI, but a lot of people need someone to come in and help them for their data center operations and cloud solutions. So Datatec will benefit from that. But maybe when Mr. Montanana decides to retire, maybe also you get some value unlock or some corporate action of Datatec, because it is a bit of almost like an investment holding company where the head office has decided to buy into a bunch of smaller businesses, and they do these stuck-in acquisitions quite often. And once the people at their head office aren't there anymore, you need to ask yourself whether the business needs to exist in its current form. So yeah, I think it could be interesting to see what happens once the CEO moves on.
All right. Well, gents, let us get to your stock picks for today. Gary, what are you choosing?
Okay, so I'm going drill, baby, drill. So I'm going with SLB, which is formerly Schlumberger. It went through a rebrand as it kind of, I suppose, repositioned itself more towards a technology services company rather than that old oil fields business that it was. At the moment, they've just done a deal for Champion X, which is another oil services business that was last year. We expect synergies to kind of flow through after that, probably around $400 million this year. They've also got a $2.3 billion US stock repurchase program. They're planning on returning about $7 billion to shareholders over the next 2 years. It's pretty cheap given that it's kind of S&P 500 company. Just in earnings terms, you're talking about kind of 12 times earnings on 1 year forward. A lot of people, the bears, I suppose, around the stock are saying that the capex pipeline for oil and gas is diminishing. But yeah, as we heard from the inauguration last night, it's drill, baby, drill. And I think it's something that they will benefit from. So even with lower oil prices, not technically an oil company, it really is an oil services company. And their digital division is doing pretty well as well, which really focuses on extracting efficiencies, which maybe will be good for the business overall.
Okay. JP, what are you drilling into today?
PDD Holdings, a Chinese company listed in the US that a lot of people probably think is going to get negatively impacted because of tariffs. But there's a few reasons I'm choosing this. I actually chose it also last year, August, a few weeks before they then had a conference call for the quarterly results where they frightened the markets and the share price fell, I think, from around $130 to $100. So it's still trading around $100 now. But they diversified away from the US, and even for the packages they ship to the US, They still have de minimis rules there, because otherwise the border patrol need to like inspect 1 million packages a day that come from China. It is ridiculous. So it's sort of like a problem that's almost too complex to solve for. So I would be surprised if tariffs are going to impact PDD negatively. And even if it does, they've got the rest of the world, because they own the Pinduoduo platform in China, but they own Temu in the rest of the world. And Temu, yes, grew very quickly in the US, but it's now available in like 80 countries or something, including South Africa and a large part of Europe. So with that diversification away from the US, that risk mitigation away from Trump's tariffs, very cheap, high cash balance, a lot of negativity towards China. That's why the opportunity exists. I think that PDD holdings at $100 is a good opportunity if you think that China is going to recover from a macroeconomic perspective, and PDD are going to solve for the tariff problem from the US.
All right. Well, thank you so much for your time and for your analysis, gents. I do understand that there are quite a few questions that we didn't get to today, but don't worry, to our viewers, Simon is back tomorrow. That is it for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Gary Booysen from Rand Swiss. Up next, The Close. Stay watching.